I realized something. You know, when we look in terms of summary tables, our eyes gravitate towards the best performer or the worst performer. Let me pull out one example for you to see. This is actually a summary table of REITs done by dollars and cents. And this is actually the segment for retail REITs. Does your attention gravitate towards BHG Retail REIT, which is the first name over there? Or it gravitates to somewhere in the middle, the worst performer, Lippo Mall Indonesia Trust. Lippo Mall Indonesia Trust actually lost 67%, minus 67% performance for 2020. That is horrific. You know, when we look in terms of summaries, we're always looking for the best and the worst. If it's the best, we'll be thinking how nice it would have been if we had bought that company, that stock. We have definitely made some profit. Or we're actually looking for the worst performer. Hey, maybe this beaten down horse is going to be so valued, it's going to turn around and we're going to make massive profits. So that's why we're always gravitating towards the extreme. What about for first REIT? It's even done worse than Lippo Mall Indonesia REIT. And simply because they are also in distress. Today's topic, are these two REITs, Lippo Mall Indonesia Trust and First REIT, about to rebound? If it's a topic that interests you, continue watching on. Hi guys, welcome back. Now, just to start things with, these two distressed REITs actually share a very similar family background. And let me introduce you to their sponsors. Lippo Mall Indonesia Retail Trust actually is sponsored by Lippo Karawaci. What about for First REIT? It's actually jointly sponsored between OUE Lippo Healthcare and Lippo Karawaci again. Now, Lippo. Who exactly is Lippo Group? Now, if you don't really know, Lippo Group belongs to Mr. Mokhtar Riyadi. He's among Indonesia's richest people. And right now, he has his two sons running OUE and Lippo Karawaci respectively. And this is actually a quick snapshot of the family tree. So what do you realize? First REIT and Lippo Mall Indonesia Retail actually kind of belong to the same family in many ways. Some have actually speculated that, Lippo's effect seemed to be a bit negative in terms of performance, but that is another story. So just to share a little bit more, Lippo Group, Lippo Karawaci has actually been in recent trouble. They've actually overextended themselves. And right now, the grandson, John Riyadi, is actually in charge. He is actually the CEO of Lippo Karawaci. So Lippo Karawaci owns, this or sponsors these two REITs itself. It's very important as a lesson, which I'll touch on towards the end of the video. Now, in this part, let me share a little bit with you about Lippo Mall Indonesia Retail Trust. This trust actually owns 29 malls in Indonesia itself. Now, Indonesia is huge. They own 29 malls in various islands. And if you compare that to CapitaLand, CapitaLand only owns 20 malls in Singapore. So actually 29 malls is not too bad, quite impressive. But if you look at the portfolio valuation, it's about 1.8 billion Sing dollars, correct? Just to give you some perspective, vivocity is actually worth $3 billion to Mapletree Commercial Trust. So again, having a lot of malls, but each of them is actually very small in terms of value in Sing dollars. If you don't really know, Indonesia's COVID-19 situation is not too good. This is actually a very recent chart. Although it's abating, you do see still very high active cases. Of course, they have a huge population, but again, this chart reflects the ability to control the spread of the infection, as well as what kind of speed retail actually recovers, which is very important for Lippo Mall Indonesia Retail Trust. If we see some snapshots about their business performance, you realize that visitor traffic has actually rebounded since April. They've actually collapsed, of course, before the April period. But this rebound was also having some difficulties in September, whereby Indonesia actually did like a second lockdown. So you see the graph increasing and then dropping again before now picking up slowly. As of right now, it looks like they have recovered about 50% of shopper traffic. And to put things in perspective, let me compare that against Mapletree Commercial Trust vivocity. Realize that vivocity right now is actually close to 60% of shopper traffic already. A lot of the tenant sales has been recovered. So if you own shopping malls in Singapore, it's very different from owning shopping malls in Indonesia, because how fast shopper traffic can rebound is totally different when things are handled differently in a crisis. I've also something interesting to show you about Lippo Mall Indonesia Retail Trust, and this chart actually shows something also. If we focus on the header over there, stabilizing occupancy rate despite COVID-19, what I'd like to highlight to you is when you look in terms of presentation from companies, very often they give you very nice headers, correct? But if you zoom in and focus on the key parts from first quarter 2020 to fourth quarter 2020, you realize that the number has been sliding drastically from 90.9% all the way to 84.5%. To me, that caught my attention. That is actually sliding occupancy rate, very worrying. That means a lot of tenants are not able to renew lease, which means loss of income. And I don't know why the title means stabilizing occupancy rate. So again, when you look in terms of books, be very critical, be very skeptical about numbers and presentation message from the management itself. If we look in terms of track record for Lippo Mall Indonesia Retail Trust, you also realize that along the years, they have seen declining occupancy rate. I don't know how it is in Indonesia, but if numbers like that are dropping all the time, maybe they're not refurbishing the malls, maybe the malls are not competitive anymore, but sliding occupancy rate is very worrying because you're compared to vivocity. Vivocity's numbers have hovered close to 100% for many years. So again, different manager, different outcome. So think very carefully when you invest in REITs in that sense. Let me show you financial numbers of Lippo Mall Indonesia Retail Trust. This is actually a very recent publish. And what you see over there is net property income has dropped by half, correct? That's something I boxed up for you. But what I want to focus is the amount available for distribution has almost evaporated. Wow, how can that be? You still have net property income and yet the amount that can be distributed to you as a REIT investor has almost become nothing, only left with 3+ million. The reason is this: when it comes to costs, there's always finance costs, there's always management fees charged. There are so many things before the amount available of distribution is finalized. That is a sign that the finance cost for this REIT is quite expensive, and it's actually echoed by this report by CIMB. You do see that they have a $250 million bond and it's actually paying 7.25% interest. If you compare that to most of the REITs in Singapore, it's hovering between 1 to 2.5%. They are paying 7.25% in terms of interest costs. And that interest cost has eaten up a lot of the distribution that's available for unit holders. So keep that in mind. So the poor performance actually caused the share price to slide. It dropped when COVID-19 actually hit. And then it dropped further again in September when operations numbers are actually very poor. And to make matters worse, you'll be thinking, hi, they should conserve cash. They should be very prudent moving forward. Try to pay off loans and stuff. Lippo Mall Indonesia Retail Trust actually did something very surprising. They actually did a big acquisition. Imagine this. You are kind of struggling and then you buy another big investment property just to get yourself out of trouble. That's kind of how I see things, because they've actually bought this mall from their parent company, Lippo Karawaci. This mall is actually Lippo Mall, and what it actually cost them is 430 million in terms of transaction costs. If you check on the market capitalization of Lippo Mall Indonesia Retail Trust, you realize that it's even smaller than 430 million, which means they're actually swallowing something bigger than their entire worth itself. Something pretty aggressive in a lot of ways. I also like to highlight to you some presentation numbers also. So they've actually mentioned that buying this mall is good for the REIT investors simply because there is a discount to the purchase, and then there's a vendor support which gives yield to the investor, and they're actually guaranteeing this yield up to December 2023. So in my opinion, this 9.41%, while it seems good, it could have already been baked into the transaction price itself. Very often you buy properties and they say they give you a guaranteed rent, especially overseas properties. That guaranteed rent is actually factored into the price itself. You're not buying a distressed price. So I'm not too sure whether it's a good number to buy at or not. And with this acquisition, the gearing ratio has spiked up from 35.9% all the way to 41.9%. This is among the highest in all REITs in Singapore. So this high gearing ratio, if they are unable to turn over loans, it's going to be quite problematic. And when I deep dive into the books, I realized that they have an upcoming loan to pay off 175 million in 2021. Right now, they've highlighted their cash balances are only about 200 million, which means a lot of the cash balances are going to pay off the loan, or if they can refi that loan, that'll be good. But they have a big loan coming up and they don't have that much cash in the bank. So to me, that is quite aggressive in a lot of ways. I don't know you get what I'm trying to hint at or not. So with that, they've actually also needed to raise REITs, which means get shareholders to buy in, give more capital to a company, and that has a negative implication on share price. You see over there in terms of December price, it's actually drop down even further. Simply because with this purchase, they need to raise REITs at a discount, and then they have to take on more loan. So I'm not too sure, what's the real strategy, but it's quite worrying that, a lot of numbers now are very stretched for this REIT itself. Now, before we get to discussions on first REIT, let me introduce you to the private channel that we have over here in this community. Over here, many thank you to all the members over there. And if you're interested to join the project on Let's Make a Difference, this project is about financial literacy. This project is about really helping those who are worse off financially to understand finance better. They can do it also. And with it, I'm trying to lead this project. And I see this as a crowdfunding exercise to have funds to build tools to reach out to them. So if you're keen, look out for Let's Make a Difference community, and within it, in particular, big thank you to Chris, Joshua, and Melvin. Now let's move on to first REIT, and first REIT is actually Singapore's worst performing REIT for 2020. They lost minus 75%, even worse than Lippo Mall Indonesia Retail Trust. So first REIT actually comes from the healthcare sector. Very surprising, correct? Because we used to think healthcare is very defensive, it's essential service. But what COVID-19 has proven is private hospitals actually make a lot of monies from elective surgeries like kneecap replacement, like plastic surgeries and stuff. So they don't actually make a lot of money from emergencies in A&E. So first REIT being in healthcare, they actually saw bad operation performance, which caused their share price to tumble. But that was not the final dagger in the coffin. They actually had a rights issue as of end of 2020, simply because they were in financial distress. Not only that, they were in trouble because they actually had a master lease agreement with Lippo Karawaci, who is their joint sponsor, by the way. So they actually give a master lease to their joint sponsor, and then the joint sponsor actually sublease this out. So that's actually how they've been making their monies. So Lippo Karawaci was in financial trouble. They wanted to renegotiate, and they've gotten it through already. So first REIT has actually significantly reduced this master lease agreement. Let me pull it up for you to see, because this is key learning points. The previous master lease agreement was huge on basic rent, 80 plus million, but the new one is very low, a lot on performance-based rent. The second difference is the initial master lease agreement was in Sing dollar, but right now it's in Indonesian rupiah. That is substantial because Indonesian rupiah has lost more than 40% since first REIT's IPO in Singapore. And that actually caused the master lease agreement to be unsustainable. So in a lot of ways, first REIT is going to see poor operational performance, and then this master lease is changed, which means they are going to take very, very long to recover back to their heydays, if ever able to get back. So while you may be thinking it's all gloomy with first REIT, some good news is that their joint sponsor OUE has actually bought in more at 21.7 cents. This is actually pretty recent news that I want to highlight to you. So they are thinking that it's cheap in value, but as of you, I'm not too sure. In terms of operations, there are key learning points. The first that I'd like to share with you. When you look at a REIT, you must question whether dividends are sustainable. And what currency is that REIT in? Do they have a good track record in managing that asset? As we can see, currency was a big problem for first REIT because the master lease was in Sing dollar. The person taking the master lease, which is Lippo Karawaci, couldn't sustain it. And then when we look in terms of track record, I've also shown you that Lippo Mall Indonesia Retail Trust, the track record of managing those properties does not seem that good. The second that you need to question is the tenant base diversified? Lippo Malls is not so bad, but for first REIT, it's to their parent company. 72% of the master lease is actually to Lippo Karawaci. And when you're not diversified, your tenant is in trouble, means you are in trouble. So look very carefully whether there's over concentration or not. It's also mentioned that it's difficult for first REIT to sell any of these hospital assets to third parties because the master lease agreement is with their parent company. It makes it very difficult for them to actually sell assets to bring in funds. So that was actually a rock and a hard place for first REIT. The third is, for REITs, it's actually very important to have a strong sponsor. What we learned from Lippo Malls is that some of their loans are at 7.25%. If they had a very strong sponsor, very likely that their rate for borrowing will be much lesser, which means a lot more distributable income to you. So a strong sponsor helps in the pipelines and giving good interest rates. In a lot of ways, it's an important consideration when you invest in the REITs. Now, since you stayed to the end, let me share with you a bonus, which is my thought process. I think both of these two REITs are not well managed. There's the track record of it is not too fantastic. That's why I think both of them don't have long-term investment merits. But if you are thinking, hey, you've listened to the whole presentation, between two, who's going to rebound a bit better? I'm leaning more towards First REIT. I think they are not likely to show a loss. The master lease has been re-ironed out already. Lippo Karawaci seems to have gotten past its worst crisis. So they are not likely going to default on the master lease. And First REIT is not likely going to show losses. But in terms of price recovery, nobody knows for sure. So hopefully you benefited, and if you have, smash the like button. And if you're thinking, in terms of healthcare sector, you want to find out more about Parkway Life REIT, check out this previous tutorial I've done before. Parkway Life REIT is well managed, unlike First REIT. And they are also having a very low borrowing cost, and they've managed to grow their dividends per unit consistently. So check out that video if you haven't seen Parkway Life REIT. Right now they are not cheap also, but if they pull back in terms of price, maybe Parkway Life REIT is something I'll be interested to get myself more invested into. So with that, I'll sign off. Check out that video. I'll see you there too. Take care and goodbye.